So the audience is mostly made up of entrepreneurs and VCs, people either looking to get funding or to get funded. So everyone was really going to want to dig into hearing about Box, its origins, fundraise, all of that. So tell me about how did it all get started?
So really good to be here. We started Box back in 2005, and the original, we were sophomores in college at the time. And the original idea was pretty simple. We wanted to make it easy to securely access files and data from anywhere, and this was a time when kind of the best-in-class technology in enterprises was, if you remember, this thing called Lotus Notes that was sort of the top end of how people collaborated and work. And then you had products like Microsoft SharePoint and other technologies, and we were using these tools in I was using them in an internship and realized it was just way too painful to just share and collaborate on data. So decided that there had to be an opportunity to be able to make it easy to work from anywhere or any device. And so we sort of decided that with the cost of computing dropping pretty dramatically, with the cost of storage dropping pretty dramatically, with the rise of mobile devices, Firefox had just been launched, so like browsers could finally deliver really interactive, rich applications. We said, okay, let's put an application on the web that let you get to your data from anywhere. So we launched that idea, and it was sort of very initially got some early traction where people would start signing up, kind of a couple dozen people at a time. Per day, and that was for us. That was the most successful thing we had ever done, and so we were like, "Holy shit! Like, dozens of people are using our application. This must be a big idea." So we decided to go and focus on it as a business full time, and so my co-founder Dylan decided to fund the company. So our first venture capital was from my co-founder, who had won about $14,000 playing online poker, and so that was really our first fundraise. Was his poker winnings, and so that funded the company, and we decided to then go and pursue the business full time early on.
So you were like, okay, Microsoft and IBM have products. Let's compete with them out of like our dorm room.
Yeah, not the best idea of all time. But we, I think like any startup, we felt like we had a very unique value proposition, which was the ability to, with no software, with no downloads, without even pulling out a credit card, being able to collaborate with anyone, anywhere. And so this sort of idea of freemium in the enterprise really kind of started to emerge around kind of 2005, 2006, 2007, and we got to ride that wave where we had a pretty disruptive business model. If you think about the traditional incumbents in enterprise technology, they had to get millions of dollars per transaction when they went to go and serve a customer. And for us, if we could get $10 a user, we were incredibly happy. And so we realized that there was this disruptive business model of focusing on end users that in the enterprise would then pull your software into the workplace as opposed to a top-down sales process. So due to the distribution model being end user led, due to the sort of kind of core product experience being much more consumer oriented, we felt like we had a disruptive opportunity to go and compete against a lot of the big incumbents, and that was the path that we pursued early on.
Got it. So funding your startup through poker winnings doesn't scale.
Well, it depends on how good you are at poker. But so in the case of my co-founder, he was actually really good. But actually, it was more of an issue of time, where it got to a point where he either had to work on the company or win poker winnings. And so we decided that we would find a more sustainable venture path for the business and not use poker as our long-term funding mechanism.
Yeah, I'm happy to hear that.
Well, for your industry, it's great.
Yeah, thanks. So how did you go about raising that first round of institutional capital?
Yeah, so our path was between our sophomore and junior year, when we really started to take the business seriously, we were living and working in Seattle, where we had grown up. And so we decided, let's go and pursue some venture capital. And so we did what anybody else would do. We looked up all the venture capitalists in the Seattle area, and we cold called every single one, and sent emails to a bunch. I remember we had one meeting where we went to the venture capitalist office, and we got this notification about 20 minutes in waiting in the lobby that the meeting was canceled for no apparent reason, and so we went home and basically just kind of dealt with another blow. We did other things that you'd expect. We dropped off a prospectus of our business model to Paul Allen's house. So we just like left it on his doorstep.
Any callbacks?
He didn't reach back out to us. So you would think that, why would a billionaire not want this amazing opportunity to invest in two 19-year-olds? But he passed on that. We actually we found the public fax number. This was the only thing that was publicly listed, and apparently we weren't savvy enough to find email addresses. We found the public fax number for Bill Gates' office, and so we sent him a fax of our prospectus, which I think is sort of like an IQ test, and like anybody he gets a fax from, he probably just definitely doesn't pay attention to. So that
half of the audience is like looking up at a fax.
Yeah, exactly. So that didn't work also. And so basically all of the Seattle venture capitalists that were either professional venture capitalists or hobbyists in venture capital rejected us completely wholesale. It made sense. I mean, we were at literally 20 and 19 at the time, going after the biggest incumbents in the world with this online storage product. And so I probably wouldn't have funded us as well. But we got lucky. There was a group of private investors. Some had been venture capitalists a long time prior. Some had been some real estate folks. And so we raised $80,000 for the company. And we sold a quarter of the company.
So was that called like a sesame seed or a sunflower seed?
Well, back then it was like, given we gave away a quarter of the company, it was sort of like a Series D. So we... definitely not the best way to maintain ownership if you're selling 25% of the company at $80,000 a pop. So we raised that.
It's a great idea.
It's a great idea if you're in venture. Probably my first bit of advice if you're an entrepreneur is don't do that. And so that's definitely the first tidbit. But we then pivoted to further cold calling. And so we sent this guy Mark Cuban an email. And just out of the blue, sent him an email about Box, and he actually got back to us. And if anybody's had interactions with Mark,
he was on stage.
Oh,
he was here.
Wait, hours ago? Oh, okay, got it. Okay, so Mark is great because if he's interested in what you're doing, like he'll literally respond within 6 minutes, and if you've never met him in your life. And so we got a response in like 6 to 8 minutes, and we had about $300,000 in funding from him within about a month of that. So that was pretty cool, and that caused us to decide to really focus on the business. So we dropped out of college and moved to Silicon Valley, and then did a little bit more kind of typical funding rounds.
Well, I'm pretty sure every investor in Silicon Valley follows you on Twitter. Is that a scalable way to fundraise?
Twitter?
Yeah.
No. I would say probably don't join Twitter until you're sort of Series C, Series D level. Otherwise, it's a huge time sink.
Got it. Yeah, I can see that.
Yeah.
So it's hard. So tell me a little bit how you've seen the fundraising environment evolve in the last 15, 10, 12 years?
Yeah.
It's been a while.
Well, I mean, it's gotten vastly more entrepreneurial friendly, and so I'm extremely jealous of any startup kind of going through this period now. I think everybody in this room kind of knows all the big mega trends. Obviously, SoftBank and all the big rounds that we're seeing. I think it's interesting. For as much capital as is entering now the ecosystem. My perspective has actually evolved pretty dramatically since when we were fundraising, and we definitely really were in a get big fast mode when we were scaling the business, and sort of around 2009, 2010, 2011, we saw that there would be a one-time opportunity for us to go and ultimately take on this market to really build the leading enterprise company in this space. And so we decided the best way to do that was to build a massive sales force, build out our engineering. And so we raised large amounts of capital to go and do that, at least large in again, a pre-SoftBank era. And so while I still would recommend a get big fast approach, because I think it's very helpful if you're really trying to drive market share, I think what we're seeing now, though, is startups or companies are doing this either without the economics in their business model to support a get big fast approach. So you're getting big fast, but you're just bleeding money at the bottom and not actually retaining healthy customers with strong economics, or you're effectively building layers and layers of complicated investment structures into the business, which then can have some pretty damaging unraveling effects that we've seen for sure. So in general, my advice to startups now, which is sort of in maybe contrast to the surplus of capital, is focus on building a profitable, cash flow positive business model with very, very strong economics. Use venture capital to fuel the expansion of that, but not to effectively subsidize your bridge to getting there. And I think we're kind of getting confused a little bit in the entrepreneurial scene of using venture capital to subsidize a business model as opposed to using it to accelerate a business model that's already working, where you can kind of rinse and repeat at scale. And so I think it's a really difficult period, because when you have so much capital as an entrepreneur, you're like, well, okay, if I can just get this next round, I can go solve all the problems that I wasn't solving before, and this will give me more time, and this will give me more ability to kind of navigate through this period. And the reality is, when you actually have that capital and you decide to start to spend it, you do start to get operationally less rigorous, and you don't actually focus on the kind of core economics of the business. And so I think it's really, really important to be overfunding the best companies, but not be funding companies that need the capital to kind of get to the next period, because you really start to make the wrong decisions in that process.
Yeah, it's really hard to talk about fundraising without talking about the WeWork effect. And part of that was the business model, but there's also a governance piece about that. And you mentioned founder-friendly. Like, is there the right balance between being founder-friendly and instilling the right governance in a company?
Yeah, I mean, there's like Gulfstream level founder friendliness, right? And then there's sort of mission oriented. Let's bet on the long term founder friendliness. And so in general, when I say founder friendly, I'm sort of talking the private jet level of founder friendliness.
Got it.
So kind of just a step before the Gulfstream. And very, very large kind of secondaries and liquidation. I think that the benefit of being founder friendly is if you have a set of founders or a founder that is very long term oriented, where that team has a very long term vision, and you want to be able to see through complex periods of the business, and that can be very important. I think from a governance standpoint, I think there's plenty that went wrong. Seemingly, I don't know anything other than what you read in the Wall Street Journal in the WeWork case. Just if you just look at the kind of
S1?
Yeah, the S1 would probably be simple enough. Yeah. So some definitely egregious use of capital. But I really think the business model is to me the most important, which is, do you have a business model where again, capital can accelerate an economically strong business, as opposed to really kind of attempting to get to another stage where somehow magically the business model starts to work, because now you're at $10 billion revenue scale, and somehow you're going to bridge to that future period. I think it's really important to get the economics of your business right very early on, and then decide how do you use capital to put more fuel on that fire, as opposed to subsidizing your growth engine.
Yeah. That's how it should be.
That's how it should be. And to be very clear and avoid any chance of me being hypocritical, we absolutely used venture capital at times to subsidize areas of the business that weren't working. But we benefited from the fact that we had a mid-70s gross margin company with all recurring revenue, and so we could afford to have some parts of the business that were like that, and as we decided to focus on cash flow positive, we got rid of those areas, the areas that weren't ROI positive parts of the business, that weren't executing properly, where frankly private capital was the reason that we were able to enter those either markets or investment areas, and we had to pull back, and ultimately built a much better and healthier business because of that.
Well, I think you bring up a good point that there is a difference in business models.
Yeah.
And so, there's been this trend that every company gets an enterprise SaaS multiple applied to their revenue for their valuation, even though they're not enterprise SaaS companies. And as an enterprise SaaS CEO, do you look at some of these and scratch your head?
Well, I don't even have one of those multiples, so I'm just more upset on that dimension. But I think you're now at the heart of sort of this issue, and so I'd actually flip it back on you in a second. But I think what the Valley did, and again, entrepreneurs have in some cases benefited, in some cases, again, it's caused actually like a lack of rigor in understanding your business. But I think what we did was we basically said all revenue is created equal, and all companies then should be valued at somewhere between 5 and 10x their revenue. And the reality is that revenue is not created equals, because some revenue is at 80% gross margin and some is at 10% gross margin.
And some of it's recurring and some of it is not
yeah,
recurring.
And I think that it's really important on your end to make sure that that the venture ecosystem is appropriately looking at these business models and sort of deciding that actually there's completely different business models in the ecosystem, and we're going to fund these companies at a different level. And what's interesting actually is we've seen this, that the public market has actually been the ultimate arbiter of how this is working. And what's been interesting is you have some companies as a private company that have actually had lower valuations than they do public, because it turned out that and I'll give you like the case of Zoom as an example. Zoom is this very, very efficient, today highly cash flow and high leverage company, and you can be even more so in the future. As a private company, venture investors were only focused on the revenue growth and not thinking through actually the profitability dynamics of this business. And so now as a public company, they're worth way more as a public company, because public investors are actually looking at this from a discounted cash flow basis, and they're saying, holy shit, this thing could generate billions and billions of dollars in cash. Conversely, you have companies that in the private market were valued in a very high way on a revenue multiple basis, but it was because it sort of was under the hope and dream that eventually this revenue would look more like recurring revenue or SaaS revenue or high gross margin revenue, and it wasn't. And public investors said, NFW, like this is not the same as one of those other companies, and we're seeing that pushback. So, what's your take on this situation?
Oh man, this is not supposed to go that way.
Well, this is how it works.
Okay.
So we both have microphones.
Fair. Look, we're seeing it change at the venture level. I think later stage investors are now starting to think about, well, I need to make a certain multiple at IPO, and this is how public investors are looking at it. And that comes downstream, and it's actually surprisingly come downstream a lot quicker than I expected.
Yeah.
So now when we do look at companies, we look at what is the quality of the revenue, and,
Yep.
and I would say 6 to 8 months ago that wasn't the case.
Yeah.
So it is happening. The question is, how long will this effect last?
Yeah. I think the really big kind of wake up call, because we had been, again, in the private market, you've focused entirely on revenue growth,
Yeah.
and for good reason, because that's how you build a really big company and that's how you're going to establish your market share. But as a public company, instantaneously you realize, oh, actually this is about cash, and this is about ultimately like bottom line profits, and it sounds like holy shit, that's obvious.
Yeah.
But when you grow up for 10 years in the private market, where it's all revenue growth at all times is what the value focus is, then instantly you get kind of hit in the head, and all the metrics begin to change, because all that public market investors are trying to figure out is how much cash can this company generate. Yep. And we're going to value the company at some point on that basis. And so if you have a company that doesn't see where you get $1 of revenue, but it goes through multiple ways of that revenue getting pulled out, there's no cash at the other end. Yeah. And so there's then no way to value that company. And I think you're seeing that kind of recognition begin to emerge, with some of the recent IPOs or companies that didn't end up going public, and then hopefully that will come downstream in the venture ecosystem, and we start to care a lot more about economics.
Yeah, I was talking last week with an investment banker, and she was saying that before she would take a company out to do the roadshow, and investors are just really excited about the growth and wanted to just hear the story and believe the vision. And in the last few weeks, they take companies out to the road, and investors are like, prove it. I don't believe this. I need to see every lever that can take this company to profitability in the next 18 months. Yeah. And that's where the conversation is going.
Yeah, it's a big change. And I think if I could tell my sort of 21-year-old self advice, it would be focus on cash flow and
better haircuts.
What's that?
Better haircuts.
But better haircuts, and definitely better haircuts. I mean, a lot of things. Don't wear shorts to work. A lot of things that I did. But definitely cash flow also.
Great. So let's talk a little bit about investors, since you put some heat on me. When you were taking funding along the way, what did you look for, and what were some of the best investors you brought around the table?
Yeah, I think we have been very fortunate where over the years we've been able to align with investors that have had a very long-term oriented approach to building the business, and that's really important for us. It's important for, I think, any startup that wants to build a business over the long run. And so, the fund does matter because obviously you want to make sure that you're hopefully in a healthy fund, one that is going to be able to support you at multiple stages in the company. We've benefited many times where our existing investors re-upped in times of trouble and kind of crisis. And so making sure that you have investors that can support you over the long run from a fund standpoint is definitely critical. So the fund does matter, but the individual partner or individual investor is also, I would say, the major factor in your success from a relationship and from a board dynamic and from a long-term health of the business standpoint, because you're going to have an individual that either can vote with you or against you, or decide to support you over the long run, or decide to not support the business over the long run, or be able to provide valuable feedback and business advice or not. And so I think being able to find people that you can put around the table that have an instinct for the type of business you're building, hopefully prior experience either building one of those businesses or being in the building stages of a company that you're trying to look like, or being on the board or investing in other companies similar to yours. And so I think and then clearly the interpersonal relationship with that investor and making sure that you've got a good working dynamic. So probably nothing that is sort of unusual or novel, but I think it is a people business, and you have to make sure that you like the people you're working with and that they have a similar passion for what you're building. We got really lucky. Our first venture investor was frankly responsible for our company's pivot to being an enterprise software company. We had come in not as a consumer company, but really just focused on individuals, whether those were individuals in the enterprise or individuals in a personal life. And our first venture investor, Josh Stein, looked at the business and we kind of looked at the economics, and he said, you could probably sell 100 or 1,000 seats at a time to an enterprise instead of one at a time to the individuals in the enterprise. But it's going to take you changing the culture and building a sales team. And we looked at it and we wrestled with that for a couple months and decided to pivot the company. And that ultimately led to our business model that we have today. So I think if you get a venture investor that has the right kind of instincts and kind of pulse on the business, then it actually can be completely game-changing for the company you're building.
Yeah, I would agree.
Yeah.
So rumor has it there's a lot of acquisition offers along the way, and you turned them all down. Was it easy to turn down these acquisition offers? Did you have your founders and investors always aligned? What was that like? How did you decide to do that? Yeah,
I think so. It's important to start with the there's always this sort of vision of the entrepreneur that had the long-term vision and said no to everything. So I want to first start with the time that we didn't turn down an offer, but it was also because we didn't get the offer. So we were there was 4 of us, and we were living in a garage in Berkeley. And
that's not cliche at all.
Not cliche at all. Yeah, actually. So we were living in a garage and working in a garage, and it's literally it was a renovated garage. And we had launched the company, and we were about a year into the business. We had all dropped out of college, and we got a call from Yahoo, I think this was a few months or a couple quarters after they bought Flickr, and so they were known to be acquisitive in sort of these Web 2.0 companies. They bought Delicious and Flickr and these companies, and so we kind of were your quintessential Web 2.0 company, an Ajax interactive interface in your browser, and kind of felt like that. And so we got a call from a corp dev and then one of the product units. And so we took the meeting. We got in our minivan and we drove down to Sunnyvale, and we were like, holy shit, this is the moment. Like this is what everybody writes stories about. We're about
it's
to
all
get
TechCrunch.
This is what we read about. We are about to get somewhere between maybe a $4 and $6 million offer for the company, and we're gonna fucking take it. This is gonna be fantastic. We're gonna be rich. We're gonna be loaded. This is gonna be amazing. Dropping out of college will have been the best thing we ever did. And we took the meeting, and we met with Corp Dev, and we met with the team, and we answered all the questions. And so we were like, okay, cool. So we end the meeting. We're like, great to meet you.
What are
the next steps? How should we think about next steps here? And they're very polite. They said, we'll get back to you. And a week goes by, and
still eating ramen noodles.
We're still eating a lot of Hot Pockets. Couldn't afford Popeyes or Chick-fil-A, and so And so we didn't get any email back, and then we eventually got an email back and said, thank you for your time. We appreciate it. We'll definitely stay in touch. And that was like a death blow. We were like shit. Like now what do we do? Like
Costco Hot Pockets.
Yeah, exactly. Yeah. So now we have to buy Hot Pockets in bulk. So there's no $4 or $6 million acquisition offer. So in that stage, I mean, we would have said yes in 5 seconds. So we didn't really have a good sense of like what we were building, what was the long-term orientation of the company. Fast forward about 4 or 5 years, we fortunately were on a little bit of a winning streak. The growth was sort of 100 to 200% a year. The repeatability of the business model was working. More and more customers were signing up in a consistent fashion. We had maybe 10,000 customers at the time in the enterprise, and so we did get kind of general offers for the business, and it caused us to really step back and say, what are we doing this for? Are we doing it because of sort of we had financial goals in mind, or were we doing this because we wanted to really kind of reshape the enterprise landscape, at least in our kind of from our perspective, and build a long-standing business that could have a different culture, have a different business model, really kind of change how enterprises thought about collaboration and managing their data. And so ultimately, it took us about a month to figure this out, but we stepped back as a founding team and we said, really, while the money would be fantastic, we care more about building a long-term business, and we want to kind of roll the dice on continuing to build that out. So it was a great clarifying event because it caused us to think about what we were doing it for and really being able to bet on the long run. And so that was kind of 6 or 7 years ago now.
And at any time, as these acquisition offers come through, did anyone, investors or founders, say like, "Hey, wait a second, this is like a lot of money. Like we could buy the Costco."
We could only have bought a local Costco, but not unfortunately the full one. But I think all of us had that doubt and that question or that skepticism or that point of view. And I mean, the T chart of pros and cons were very robust, and every person who wanted to sell also had good points of why not to sell, and everybody who didn't want to sell had good points of why we should sell. So we treated it as a highly rational process of looking at the metrics, figuring out what do we think the long-term value of the business is in multiple scenarios, and then layering on top of that a somewhat personal view of what are we trying to build here. And then we wouldn't have been able to land on our personal view if the financial aspects or the metrics didn't support it. Yep. But there was no question that we had to be really big believers in the long run to decide to say no to some of the offers, and fortunately we were.
So that takes you all the way to, just fast forward a bunch of years, to IPO.
You're fast forwarding through all the hard parts, but yep.
Yeah. We only want to talk about the easy stuff, right? So you filed your S1 when the market was really shaky for enterprise SaaS
companies. You're going to talk about one of the hard parts. Good. Okay.
Yeah. Did it feel like the right time to go out? Is there a right time?
Yeah. It felt like the right time.
Even though the market was like...
No. It felt like the right time, and then very quickly we discovered it was the wrong time.
Oh, okay.
So we would not have done it if it hadn't felt like the right time. So we filed to go public, and then literally within 3 days, the SaaS market, it was specific to SaaS, it was very weird. Just the SaaS market dropped by like 30 or 40%. And so basically all the public market investors were basically giving feedback to our bankers, which is like, hey, we don't need more new IPOs right now. So we actually decided to hold back, and in particular, the knock on us was we were burning way too much cash. So we actually stepped back and we said, you know what, market's not ready, we're not ready. And so for about 10 months, we decided to go clean up the business and get the business model in an improved state. Make sure that we were much closer to cash flow positive. We ultimately were able to nearly double revenue in that time period as well. So a lot cleaner kind of business model, and then the market rebounded. So I think it is very important that you go out during a good market for your specific sector, because you do need to catch investors at a point where they're interested and willing and excited to listen to your story, because those investors that's going to be the moment that they decide to kind of be with you and continue to support you over the long run. So we did catch the market at the wrong time, but fortunately we landed in a better spot.
So you would have done it exactly the same all over again?
Yeah, definitely not. If I could do it all over again, I would have gone public when we had cash flow. When we were cash flow positive, I think is the better time to go public. But that being said, I'm very, very happy about being public. I highly recommend being public, assuming you have the operational rigor, you have the business model, you have the team in place. That is really, really important. And some companies go public too much premature, and then you have to deal with fixing a business with the added public scrutiny and the stress of quarterly earnings. And fortunately, we had at least a business model that was working. It just needed to improve. But I do think some companies go public too early. There's a couple cases where companies go public too late. I don't think that's actually as big of an issue as maybe news stories would make it seem.
Yeah. So I want to switch gears a bit because you are actually an investor yourself.
A little bit, very, very, very infrequently.
I mean, you have a pretty incredible portfolio. You have Stripe, Gusto, Nginx, Authy, Instacart, Robinhood. So, pretty successful portfolio, I would say. What do you look for? How do you figure this out?
Basically just any company that might be worth like $10 or $20 billion is sort of my focus. So I've gotten lucky a few times on that. But I'm a massive. I live, eat, breathe innovator's dilemma, and so I like if I had one tattoo, it would just say like Clayton Christensen on my leg or something.
He's not even like disruption.
Yeah, I'd probably say like disruptive innovation. And so what I look for when I'm very infrequently investing is very, very obvious markets that have been held back by incumbents, where if you could bring something that's cheaper, faster, better, usually large horizontal markets, that with hopefully a founding team that is very ambitious and has a strong vision, that's sort of the combo pack that I personally look for. But I think that if all you did as an entrepreneur was just study Innovator's Dilemma and you just only did that, and found where there are markets where you have an incumbent that's held back by either a business model or an organizational design that is preventing consumers from getting the best either quality product or cheapest product or most efficient product, that's a really good starting point. And I think unfortunately too many startups get started because they think an idea is novel or interesting, which is fine. It's very good to be passionate about the product, but you do have to make sure that you can succeed and there's a business here, which means you have to make sure that there's something disruptive and not in the sort of way that we toss around disruption, but quite literally either creating a new market or being a low-end disruptor to an existing category or market, which is really due to the design of your business model more than anything. And so those are a few companies that I think have been able to crack the nut on that with founding teams that are very ambitious, but that's mostly what I look for.
Awesome.
Yeah.
Well, we're out of time. I could talk to you for much longer, but thanks for coming by today. It was fun to get to poke fun at you now that you're not my boss.
Yeah. I have no recourse now.
Exactly.
Okay.
This is
all right.
great.
See you. Thank you.
Thank you, everyone.